Here is a fact Wall Street would rather you never see. Over the last 20 years, 91% of professional stock pickers trained analysts, research teams, seven-figure salaries lost to a machine that does not think. It does not read the news. It does not have a strategy. It just buys everything. And when it launched, the industry called it un-American. By the end of this video, you will know exactly how the machine works and why the smartest money in the world quietly surrendered to it. The number comes from S&P's own referee report, the SPIVA Scorecard, which has tracked every U.S. active fund against its benchmark for more than 20 years. Through mid-2025, over a 20-year window, 91.03% of actively managed large-cap funds underperformed the plain S&P 500. 9 in 10 professionals paid to beat the market, beaten by the market. So what is this machine? Act 1. The Folly. Because the most successful investment product in history launched as a complete flop. August 1976. A man named John Bogle launches the first index investment trust, a fund that would not even try to pick winners. It would simply own all 500 stocks in the index, automatically, at almost no cost. The underwriters hoped to raise $150 million. They raised $11.3 million, a 92% miss. Rivals called it Bogle's Folly. One executive called indexing un-American. Another called it a sure path to mediocrity. The banks suggested shutting it down. Bogle refused. Bogle's whole philosophy fit in one sentence: do not look for the needle in the haystack, just buy the haystack. Stop guessing which stock wins. Own all of them, pay almost nothing, and let the market's growth do the work. Strip the jargon, and an index fund is 4 ideas. 1. Own everything, all 500 companies in one purchase. 2. Fire the stock picker. The fund copies a list. Nobody makes decisions. 3. Because nobody is paid to guess, the cost rounds to almost zero. 4. By construction, you get the market's return. Never more, never less. That last line sounds like a limitation. It is actually the weapon. Follow a dollar through it. Your money goes in. The fund buys a slice of every company on the list, biggest to smallest, no opinions attached. The 500 companies do what they do: build, sell, grow, pay dividends. And nearly all of that return flows straight back to you, because there is almost nobody standing in the middle taking a cut. That is the entire trick. The machine does not win by being brilliant. It wins by not charging you for brilliance. How small is the cut? In 2025, the average index equity mutual fund charged 0.05% a year, 5 cents per $100. The average actively managed equity fund charged 0.64%, nearly 13 times more. And that gap sounds tiny, until you remember it compounds against you every single year, whether the manager wins or loses. Run identical twins through both doors. Each invests $500 a month for 30 years, and the market delivers the same 7% before costs. The index twin pays 5 basis points and ends with about $604,000. The active twin pays the average active fee, and that fee alone eats about $66,000 of the exact same market return. Same paycheck, same market. One twin paid a toll every year for the privilege of probably losing to the other. And that is before the managers even start picking stocks. Act 2. The Scoreboard. What happens when they do? SPIVA publishes the win-loss record at every horizon, and the pattern is brutal. Over 1 year, 72.6% of active large-cap funds lose to the index, and a losing year can be luck. Stretched to 10 years and 86% have lost. 15 years, 88%. 20 years, 91%. The longer the game runs, the more the fees and the mistakes compound, and the fewer survivors remain. Time does not rescue the professionals. Time is what buries them. The most famous test of this was a handshake. In 2007, Warren Buffett bet $1 million against a hedge fund firm called Protege Partners that a plain S&P 500 index fund would beat a hand-picked basket of hedge funds over 10 years. The professionals got to choose 5 funds of funds, covering more than 100 hedge funds with every tool Wall Street has. The index fund got nothing. It just bought the haystack. 10 years later, it was not close. The index fund compounded at about 7.1% a year. The hedge fund basket managed about 2.2. Even the single best fund of funds, the champion of the champions, still finished behind the plain index. Buffett's winnings, over $2.2 million by the end, went to a children's charity in Omaha. The pros never asked for a rematch. The world noticed. In 2023, for the first time in history, passive index funds held more U.S. fund assets than active managers. Roughly half of every fund dollar in America now rides the machine. Wall Street spent 50 years calling indexing mediocrity, and then watched half the country's money walk into it. Which raises the real question. These are smart people working 80-hour weeks. Act 3. Why the pros keep losing. 4 reasons, and none of them is stupidity. First, the market's return is the average of everyone in it, so before costs, active managers collectively are the market. They cannot all be above average. Second, subtract their fees and trading costs, and the group must underperform. That is arithmetic, not opinion. Third, the few genuine winners rarely stay winners. Hot funds attract floods of money that smother the very edge that made them hot. And fourth, a manager who hugs the index keeps his job. While a bold bet that fails ends his career, so many charge active fees for index-like portfolios. Buffett said the quiet part in his 2016 shareholder letter. When trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not their clients. The fee arrives every year, guaranteed. The outperformance usually does not. None of this means the market is safe. The index crashes when the market crashes, and 7% is a long-run average, not a promise. And a small minority of managers really do beat it. The problem is that 20 years of scorecards say you cannot reliably pick them in advance, and S&P's persistence studies find that today's top quartile funds almost never stay on top. Betting on the 9% is a lottery. Owning the average is a system. So what transfers to you? The playbook the evidence supports is almost insultingly simple. Buy the haystack, a broad, low-cost index fund. Automate it the same amount every month in good markets and terrifying ones. Ignore the noise, the forecasts, the hot tips, the manager of the year. And let the 20-year clock run, because the scoreboard only tilts to 91% when you give it decades. The hard part is not intellectual, it is emotional, doing nothing on purpose for 20 years. One last warning, because this channel deals in mechanics, not cheerleading. Index funds concentrate. The biggest companies dominate the index, so you are riding whatever the giants do. A market crash is your crash. There is no manager to blame. And this video is education about how the machine works, not a recommendation of any product. The mechanism is public. What you do with it is yours. The machine that beats 91% of professionals is not clever. It is cheap, it is patient, and it never gets scared or greedy, which, it turns out, is most of the game. If this rewired how you see Wall Street, subscribe. Every number you just heard is sourced in the description, alongside the other mechanics channels. Because next week we follow the money in the other direction. What inflation actually does to your paycheck, the mechanics of why your raise keeps evaporating. The more you understand the machine, the better you can play it. See you in the next one.